Hi everyone, how are you doing? This is Al. So you are in the channel Two-Face Investor. Last time I told you that I will share with you what type of portfolio I'm about to start this year. So here we are. Please welcome. So the topic is building an AI-driven fee-efficient portfolio with like $1,500. It's almost 16, but yeah, as you see. So the plan is to hold this portfolio at least for in a year, for the year between 2026 and 2027. I believe this is enough time at least to show some sort of dynamics. But of course, in case of a variety of reasons, the portfolio will show itself being negative, which is yet, of course, possible. This will become at least kind of balanced portfolio, which I will be able to hold for a long time. And also, I wanted to show what type of conclusions I've done from the last experiment, which kind of uh, led me to take sort of several recommendations from myself uh, in order to make an efficient portfolio and avoid the mistakes I've done last time. And lastly, of course, I want to continue to show well balanced portfolios, which will sort of you will be able to understand the thinking behind of making such portfolio and try to make something similar or maybe the same, but it's up to you, of course. I don't ask you to follow the portfolio. It's just the idea behind making portfolios, and I hope that the thinking of mine will help you making your own portfolio. Okay, let's start. So, from the last video, let's recover the information. So, I said that my portfolio overall showed 45% yield. And if we take out one position called Micron, so basically my yield still stays slightly above 20%. It's okay because Micron is more of statistical anomaly and it showed 300% growth, even higher, in fact. And I don't think it's okay to include it here because you may find such a performer or not. Depends on you, but yeah, I wanted to avoid misunderstanding and misinterpretation of such yields because it's more of a rarity than a rule. Okay, so well, first of all, what I wanted to recommend to myself after making okayish portfolio last time and kind of found mistakes last time and I wanted to avoid them here is of course hidden fees. And last time I told you about TER, total expense ratios. And in one of the position, the expense ratio was 1.39%. It might seem to be fine, but if you extrapolate this fee for 10 years, it takes a very high portion of your uh, income. And yeah, sometimes it's just 20% of the gross. And yeah, it's enormous amount, in fact. Then the second thing I wanted to avoid, but it was automatically avoided. I don't want it myself to be kind of lured by high dividend yield. Last time I added Electron Credit Company because it had 13.5% yield in the dividends, but I missed the information about how the price of a stock itself performs throughout a time period. I thought, I hoped, in fact, that it will stay at approximately same position as they were at the beginning, but I was wrong, and eventually the price itself went down about more than 25%, I believe. And after subtracting the dividend yield, I received negative 12% gain. And so these are two main kind of errors I made last time, and I wanted to avoid them here. But this second one was avoided by itself because this time we are making a tech portfolio. And as you may know, the tech ETFs as well as single stocks, they usually don't have enormous dividends. Sometimes they even do not have them at all. Uh, Another thing is that while I was constructing the portfolio, of course, as you may know, the entry barrier may be high. If you want to invest in a good stock, sometimes the price per share is quite high. An example may be the Meta company, which has a price over $700. And as I said before, I wanted to invest just 15 to $1,600. And if we take one single position in Meta, it will be enormous exposure to it. So we need somehow to manage this as well. Okay, so last time I also told you this story, but let me repeat myself. Before constructing the second portfolio, I started to sell my assets from the last one, and I tried to execute some sort of speculative deals during that time. And I bought some Nvidia shares and also ETFs for uranium miners and gold miners. Uh, yeah, so some positions of Nvidia, I believe, lost like 11%, while uh, uranium miners lost like 6.5% total, but I didn't sell them at once. Uh, I waited for several days. The gold continued to grow. The gain for the gold miners, I believe it was about 19% for me. And what I did, I sell them when the overall gain was slightly more than 3%. So this is the conclusion from my speculative deals. This is very hard to do, in fact, to make consistent gains. But I was lucky this time. It was okay for me to kind of risk slight amount of money. But yeah, of course, I didn't bought them for all $1,600. It was much lower amount of money, I believe. Uh, Something near $500. So it's like 30%, still huge amount. If you take it's as a fraction of portfolio, it's still quite huge, because usually, as you may have heard before, the speculative portion shouldn't take you more than 10% or out of your whole portfolio. But this time it took like 30%, which is large. Okay. Uh, Still, this action reminded me that it's still my money. Like, okay, this is the experiment which I want to share with everyone. Of course, I allocated some money, but it's still my money. And I want to make sure that they are kind of invested in a good way, like uh, intelligently invested, rather than hot-headedly pushed towards most hyped assets and so on. So of course I needed somehow to combine AI with sort of hedge assets. And Okay, so this is the insight that I gained from the last slide. Another thing is that besides of uh, hedging, I needed to think about the AI portion itself. Well, of course, I wanted to invest in a broad index fund, whatever, and make the main portion more of stable one. But on top of that, I wanted to have sort of slight aggressive portion, which is usually the case for majority of investors. And of course, you should be familiar with the companies involved in the Magnificent Seven sort of group, and it involves such companies as Tesla, Microsoft, Meta, Amazon, Apple, Nvidia, and Alphabet. Well, I wanted to have all seven of them because I'm really prone to them. Yeah, I love them. In fact, yeah, they all have its own pros and cons, but still, if market believes in them, I might take an advantage of this lavish behavior towards them. Okay, but still, as I said in the very beginning, I have a price wall. So my budget was slightly over $1,500, but some positions like Microsoft, Tesla, Meta, they have they are kind of their price is nearby 400, even sometimes some of them $700. The another five of remaining assets, they also quite expensive. I believe like somewhere between $200 and $300 for Alphabet. Yeah, in case if you buy a full uh, common share of any of these companies, well, first of all, you would not have enough diversification, and secondly, the proportion of each stock will be unequivalent. So unequal, yeah. So, so another thing that I may have to do is to buy a new ETF called Max, which basically involves all seven companies involved in the Magnificent Seven in the equal proportion. But yet it still had a TER. It's not huge. It's okayish, in fact, but still, it was my kind of last option. And what I remembered is that during 2025, an stock exchange called ITS introduced called single stock ETFs, which are basically one hundredths of a single share. So basically, you have a Tesla 1 divided by 100. So basically, each ETF involves just a single stock, but it's split into 100 sub shares. Why do we need such assets? If you may ask, because in the West, your brokers usually have an option of buying fractional shares. Here in Kazakhstan, we do not have such brokers. Only one, I believe, but it's still kind of in the beginning of its journey, and the fees from that brokerage are still quite high, so I didn't want to use it. So instead, I decided to use this type of ETF. And interestingly, is that the kind of liquidity within that market of single stock ETFs is much lower compared to the regular market, of course, and you may find some sort of arbitrage during that period. So what I did, I believe it was Meta. Yeah, it was Meta. So I bought it in a certain price, and at the at a certain moment, what happened is that this single stock ETF was selling 6% higher than the usual Meta stock. So I decided to sell it. But after I sold Meta ETFs, what happened is that I wasn't able to buy them on a fair price. So I didn't want to pay 6% premium towards any type of thing that I might buy. So instead of buying Meta, I decided to substitute with AMD stock because at that moment it was in a fair price value. So cumulatively, I bought 6 companies out of Magnificent Seven and substituted Meta with AMD, which is still great company, I believe. Okay, this is the culmination of this video. So this is the portfolio that I created for this experiment. Well, of course, I tried to be as diversified as possible. So this portfolio has 3 main fractions, which are the core, hedge, and growth. The core has 3 types of ETFs. One for the stability, it's QQQ, and it's interesting that QQQ. No, let me begin with this. So initially, when I was creating this portfolio, I wanted all of my assets to be from Kazakhstan Stock Exchange. Why? Because last time I already told you, if we trade within the Kazakhstan stock market, we do not have any tax because we are Kazakhstan citizens. And you just declare the yield, but you do not pay taxes yet until 2066. Well, and many of the positions that listed here are in the Kazakhstan stock market as well. And they have a special subticker, which is QQQ underscore KZ, which is the equivalent of the regular QQQ, but this KZ indicates that it's local variant of Nasdaq 100 ETF. Well, I was able to buy all 3 of them from the Kazakhstan Stock Exchange because the price of the local ETF was equivalent to the ones that were traded in the US market. So I bought QQQ underscore KZ, bots underscore KZ, and FLGB underscore KZ as my core part of the portfolio. QQQ, you must be familiar. It's a Nasdaq 100 ETF. Basically, it's an index of the 100 tech companies. It's not really kind of only tech. Sometimes there are some uh, other sectors involved as well, but like majority of those 100 companies are tech. Then bots. Bots, it's an ETF which uh, exposed to the companies involved in the artificial intelligence and robotics. So there are various companies. It's quite okayishly diversified, so I bought it as well. This is slight enhancement of the QQQ and also FLGB. FLGB, you might be questioning why I bought it because it's a ETF which is exposed to the stock market of the Great Britain. Yeah, uh, it might not have such a huge amount of the tech companies, but it does have some financial technical technology companies. That's why I bought it and introduced here within the portfolio. Also, they kind of function as a slight diversification of sort of geographical diversification, especially during current uh, kind of waves of uncertain geopolitical positions of the US towards and towards the world, and we don't know how the market will behave. And I already have majority of my assets being exposed towards US. I wanted to introduce something outside of US, and it's not a big fraction. I believe like 5 to 10% must. Um, no, it's 7%. Yeah, it's okay. not huge, but yet slight diversification. Well, what I wanted also to share with you is how I was thinking about my physical hedges. Well, of course, the tech itself already says it's a risky sector. How do you want to hedge yourself while still having tech-oriented portfolio? Well, my thought process was as follow. Well, I wanted to have an XLU ETF, which is also kind of listed here in Kazakhstan. Unfortunately, we do not have all 11 sectors introduced here in Kazakhstan, but we do have a special ETF for the utility sector. And it's wonderful because this sector actually a powerhouse of those tech companies. So basically, they provide the electricity to them. And of course, in my opinion, it's more of a base ground, yeah, base asset. That's why I bought it here. It's still not direct exposure to the tech companies, but it's defensive and it's cool and it's somehow related to the technology. Yet, I also bought another individual stock with ticker FCX. It's a Freeport Macronen company, which is basically a copper miner. So powerhouse, this one supplies them, provides the copper to build wires. Yeah. And also, of course, copper is needed in the majority of the data centers, server rooms, etc., 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 which is also very, very necessary towards the technological sector. And lastly is PHO. PHO is an ETF which involves the companies which mine, not mine, but kind of somehow involved into the water. Uh, I'm not sure, purification or kind of not the mining, but it's what it is, collection. Yeah. So those companies are here, and as you may know, water is must-have commodity to the technological sector because this one is the asset that cools all the data centers and all AI companies. They have huge, massive data centers which must be cooled somehow, and the water companies benefit from that. So I believe this one is also a hedge asset. In my opinion, they shouldn't correlate very much, but they might still. But yeah, without being directly exposed to only technological companies, I introduced some diversification, which act as a hedge in the following scenario. And lastly, of course, the growth portion, as I said before, these are ones that are made of single stock ETFs. So each of these 7 positions is uh, equal. Initially, yeah, they might kind of uh, deviate throughout the year from the initial portion, but at the beginning, each one were introduced as a 1/7 of 12%. So basically 12 divided by 7. This is the weight of each individual ETF here. Yes, slightly, very small deviation, of course, exists, but this is the main idea. And as I said, all Magnificent Seven companies except for this one, but this is a substitution for Meta. And I believe this is the wonderful portfolio, in my opinion, because you have the core uh, part, which is 60%, almost 30% of the hedge, and 10% of the growth part. This is, in my opinion, 13 types of assets that are quite well diversified. Of course, in the more um, kind of uh, standard way, you might get even a more diversified portfolio, but this time this is the most I can do at the moment. So that's it. So during this experiment, what I want to investigate to see is the mass. Of course, will it outperform the market benchmark, which is S&P 500? I wanted to share with you how I feel during losses or gains, what is my kind of feelings, and I want to continue having of the discipline of not selling during the bad times and see myself how I will behave during that time. Of course, I wanted to show that with $500, which is not small amount, of course, but yet okay-ish, in my opinion, you can have a well world-class portfolio, being diversified, yet to be aggressive, yeah. And of course, I want to show how you should think about the TER to avoid the reluctant fees that you might be exposed to. So I forgot to mention that those single stock ETFs, they have zero TER, so which was beneficial compared to max ETF. Yeah, so this is end of the presentation. Subscribe to this channel. Turn on notifications, because during the year I will try my best to share with you the progress every single month, but at least it's going to be done quarterly because I have very many things to record, and I'm not sure if it's going to be only about this experiment, but this is the interesting part that I want to be involved to and share with you, of course. Well, if you have any comments, you are more than welcome to write them. I will be happy to read it. Thank you very much for your attention, and invest thoughtfully. Yeah. Have a good day.